Good evening. My name is Justin Casey. I currently serve as the treasurer and board member of one of the board members of Almond Glen HOA. Preparation for September 9th meeting. Thought it'd be helpful to put together a quick video on how net income is calculated. We saw a preview of this in the August 19th meeting, but we had some vendor estimates that had to be revised after a change in landscaping vendor. Went back to the insurance vendor, got a revised estimate that changed quite a bit. And so the net income for 2023 is a different split than people might have been used to seeing from the August 19th meeting. But that's why we go back. That's why we try to get it tighter, and we try to work through the accounting as best we can. So I'll go into this PowerPoint first and try and make this entire video as short as possible, and then leave the detail to any detailed questions to the meeting that we have tomorrow. So the first thing to calculate 2023 income that we need is two reports from AMG called a GL income statement, 12-month with budget. GL detail standard report was come straight from AMG's VMS software. And a couple of other files are audits from 2022 and 2023, AMG's financial statements, which are unaudited. And these 2023 financial statements are going to be the basis of our net income after we determine that we can rely upon them by pinning the balances to the beginning and ending balances to the audits. The reserve study is a key input for a percentage of interest attributable to townhomes versus single family home. Then a series of vendor estimates, particularly related to landscaping and insurance. So I'll flash this on the screen. This is kind of the output of the entire process. So we will get into this. We will recalculate every number here that you see on this slide. But this is a level of a visual level of understanding that a homeowner has never had access to before. Basically, for 2023, a town homeowner and a single family homeowner, with any level of accuracy, understanding where their dollars went. You know, the number one question I get asked as the treasurer from members and board members as well is, where is the money going? And we pay into AGOA, and then what happens to it after that? And so some of it's spent and some of it's saved is the easiest answer to that question. And then the what is it spent on is a question in itself. And so here is the breakdown in level of granularity that, again, we've never had access to. So I'm putting this on the screen at the beginning of the video to try to pretty much warn homeowners, who are interested. This is going to be a longer video, maybe a 45-minute video. I'll try to keep it as short as possible, but putting the end result on the screen as a summary just at the beginning. So feel free to pause this. I think it's pretty intuitive, so I'll just hit some highlights. Basically, you see the amount of contribution that a single family homeowner makes was about $65 in 2023. That was matched by the town homeowner. And then after the town homeowner matched the single family homeowner's general reserve contribution of $65 per homeowner, the average town homeowner, well, not the average town homeowner, every town homeowner had $570 left over. And that was contributed directly to the Town Home Reserve Fund. Some other things to look at when you're looking at this table, the common expense section, the amounts that the owners are paying are equal, directly equal. And the townhome only expense, if you were a townhome owner, you paid $25.80 into the association. in 2023, and you spent 136 of that on trash removal. You spent 720 of that on landscaping. You spent 160 of that or so on maintenance for the townhomes, and you spent a lot of that, $564 on insurance. We can talk more about insurance later, but if you were a town homeowner or a single family homeowner, you spent $68 on management co, $50 on the pool, okay, $73 on landscaping for common areas. And we got the common areas a lot tighter after last meeting, so I'll divide. I'll go in. I'll dive into that rather. One of the first things in this video. Common maintenance, $33 for that's essentially the pool and the clubhouse and irrigation, things of that nature. Um, Common insurance, so most of our insurance is for the townhome dwellings, but there's a little bit of other insurance, and so each homeowner pays $8 into that. Utilities, that's keeping the lights on and keeping the water running. That's an important one, and that's the majority of it. 163 per homeowner. And some really negligible costs, but if you're interested, there it is. So each homeowner paid about a quarter into the website in 2023. Each homeowner paid about $35 for legal expenses, accounting expenses, etc. Um, and yeah, that's it. So the single family homeowner saved about $65 in relation to a $464 contribution. And the town homeowner saved about, after making a general reserve contribution, saved in total about 640, but after the general reserve contribution, saved about 570. So, okay, let's dive into how these numbers were created. And so I understand some homeowners are going to want the nth level of detail that I couldn't possibly cover in a matter of 3 or 4 videos. And some homeowners, are going to stop watching after this. So if you're a homeowner who only wants the keynotes, I'd recommend, now's a good time to stop watching. But pretty much here with the first thing that we need to do to calculate and rely upon net income in any fashion is to pin the AMG statements to beginning cash and ending cash. And the way that we get that number is from the audits for 2022 and 2023. So basically, right, AMG gives us financial statements, and AMG's financial statements are internally generated documents. So any number that we come up with coming off of this internally generated document, we have to pin to a reliable external document. So if we didn't get the audits, I would call those the bank statements. But since we do get the audits, I would call those we can pin beginning and ending cash to the audits. Okay. So the way to calculate our total cash fluctuation from beginning of the year 2023 to end of the year 2023 is, first of all, to look at the beginning of the year cash in 2023, which is on our end of year 22 statement of 808,522. So the association had 808,522 in cash. This is an audited balance, right? So this is we get this from the independent auditors report. It's the highest level of financial assurance. They're looking at the bank statements and the investment statements, and they are making the determination that with high level of reasonable assurance, AGOA Inc. had $808,000 at the beginning of 2023. Okay, we put that beginning cash number here. Okay, then the ending cash number here, and then we'll back into the fluctuation. So the ending cash number, the statements that we get are the audits that we get are a little challenging to read for some folks because they're essentially on an accrual accounting basis. Whereas AMG's statements are on a cash accounting basis. So I'll repeat that, for anyone interested. AMG records on a cash accounting basis. So only cash runs through our income statement for AMG's generated statements, whereas our audits are produced on an accrual accounting basis in accordance with US GAAP. So that's why you see prepaids and receivables on our income statement, or on our audited balance sheet, but not on our income statement. So in order to get ending cash, we can flip to the cash flow statement if we want to, but this is probably even more hard to read for some folks. But going back up to the asset section, basically we're just going to take cash levels, which is cash equivalents and certificates of deposit, and the assessments receivable and the prepaid insurance are like accrual accounting JE calculations. So we'll never get those to tie to the Allman Glenn statements due to the timing differences inherent in those. But it basically take those numbers from the 2023 audit, 679, 327 plus 204, 274. If you see here in the formula bar, it gets us a total number of 883. 201. So just took those numbers from the 23 audit, and then we try to back into what's in between. So basically, the net income for the AMG statements, the way that we get that, and by net income, I really mean cash fluctuation, right? Because it's on a cash basis. As we flip to, this is a 7-column report. This is what the board gets each month. Basically, go to the 4th column in, it gets you year-to-date actuals. So from the 12/31/2023 statement, year-to-date actual is end of year. You take this last number here, which is the excess of revenue over expense, and you add back. We had a reserve contribution, which is nothing else than a transfer from a checking account to a savings account. So on the AMG statements, they run it on a cash basis, but it's really you just made a transfer from your checking account to our savings account. The cash level hasn't changed. So we have to add these two numbers, 14 and 14,864 and 4,804, and that's our net income from our AMG statements, and that gets us a dollar amount of 864, 191, and then the interest accrued was the last reconciling item as of year end. So again, right, interest receivable but not paid out is accounted for on a accrual accounting basis, but AMG, we're not going to see that interest until it's paid out, and basically the investment matures on the AMG statements. So in order to reconcile the cash fluctuation per the AMG statements to the audited financial statements, we need to take out the interest accrued. And so going to the 12/31 bank statements, we see here, we had 4 certificates of deposit, these gray boxes. We had 11,639, 34.95 of interest accrued, 1602, and then 2671 of interest accrued on these investments. And so just adding those numbers here gets us our reconciling item that allows us to agree the AMG statements to ending cash. And after we pin beginning cash and ending cash to the external audit financial statements, we can begin the next phase of the net income calculation. So if you're with me so far, great. 55,669 is the number to keep in mind, because this is basically the total cash fluctuation from beginning of the year to end of year. Okay, looks like we took in this 4,000 series accounts here of 286, and we spent, except for the reserve contribution, about 230. And so again, the reserve contribution is just a transfer from the checking account to the savings account. It's still money that's owned by AOGA Inc. It hasn't been, it's not a cash outflow, so to speak. So we just add that back in the calculation. And so this 55,669 is the number to keep in mind, and this is the number that we pinned back to the beginning of the year and end of the year audits, which are externally generated documents and very reliable. That we were able to reconcile that. That gives me a basis of reliance for the 55669 in the that we're about to split up here. So every piece of the video that we're about to do from here is basically a question of how is this 55669 divided by a town homeowner versus a common a single family homeowner. So the first thing to do is to get this document here in Excel, right? You can't really do good data analysis off of a PDF document. So this is back to the one of the key reports that AMG gives us, which is a GL income statement, 12-month budget. Okay, so pulling that up, it's exported directly from VMS, which is village management software. It's what a lot of HOA property management companies use. So we make sure that the name Almond Glen is at the top and that it's for the whole year, which is evident here. And the way to read this report at first is basically it's the same information as on the PDF, but it's takes a little bit of data changing to be able to analyze. So it's like our actuals are in this first row, but the account numbers are on the row below the account description. And so we need to fix that. And we really don't need the budget and the variance in order to, purposes. So just made a formula here to get the accounts in the same level for the actual. There's some duplicate values, and I'm breezing through this because it's not important for how the division works, but there's some duplicate values, so we need to make a pivot table, and then we basically copy and paste this pivot table, and that's how we get to this pivot tab here, right? This was all just a copy and paste on how we got to the number is the same, right? 55669. So all of the ways that we need to change the key report, the numbers don't change. But this is how you get our information into a 3-column format. Okay, so from here, the first 3 columns, if you followed me so far, this is where I might lose you. But we've basically gotten our GL detail into, excuse me, not the GL detail, the income statement into a 3-column format. The income statement is a reflection of the cash fluctuation, and we proved that out by tying the beginning of the year cash and the end of year cash to the audits within a dollar reliance, which gives me good comfort to be able to rely on the AMG statements as statements that I can use to make a determination of net income. So that's columns A through C. Okay, so let's talk about column D. This is ironically what takes the longest amount of time to do, and I'll try to breeze through it as quickly as possible, and able to answer any questions during the meeting tomorrow. But basically, the next step that we have to do is make sure that if we can rely on the 55669, the next thing we need to do is, prior to making any allocations, is ensure that electricity, for example, 610, account 610 is in fact accurately stated before we make any divisions on it. And trash removal is accurately stated, before we put it all to the townhomes. And so, that requires a scan of the GL detail and making sure that things are appropriately coded. And I highlighted these accounts here because the blue accounts are insurance. I'm not sure why 65 155 was coded for one of our vouchers, but the rest of it went to 50 155 from an account number. From the account numbers, somebody new might have been accounting for this and didn't realize that the most of our insurance goes to this. But you see that sometimes when you're looking through these statements as to multiple accounts for the same kind of activity. Um, no accounting group is perfect, I suppose. I don't do the accounting for this association. AMG does the accounting. We just kind of look at it at the end and try to understand it and make sure that things are placed appropriately. But if they're not placed appropriately, this is the chance where we basically find it, right? This is how we catch it, by doing a scan of the GL detail at year end. So I'll go into the GL detail now. And basically what we do here is this is the second key report from the PowerPoint General Ledger Detail Standard report here. And so, we make sure it's related to Almond Glen. We make sure it's for 12-month period of time. And we do a scan of the basically vendors here, and the dollar amounts are coded to the appropriate account. Okay, so basically what we would see here is Almond Association Management Group did our tax return. So is it appropriate that that is coded to account 5145, which is called tax prep? And the answer is yes. So, okay, now we can move on to legal expenses. I whited these out because they're related to something that shouldn't be right on a recorded video, but they all relate to legal expenses and the amounts are appropriate. Insurance, we're looking at the vendor being Travelers, which is our insurance provider. So that's all appropriate there. Management services being coded to 5160 management services, all related to AMG. This is our contractor amount, so that's all appropriate. Meetings, Bell Johnson Community Center and our annual Zoom costs, that's appropriate. There's our auditor that's coded to accounting 5205, so that's appropriate. Property tax, yeah, no issues with reserve advisors being coded to reserve study. Website, we had a renewal cost, so that's appropriate. Administrative, this is AMG, right? Mostly, and you see some other information here, like what is a reverse draft and what is a partial return, and what is a bank reconciliation service fee. And this service fee here is the same description as the service fee that was up here. And so the bank reconciliation service fee was coded to account 50100, and then you go down to the administrative line, and you see that the service fee is coded to bank reconcile service fee charge is coded to 5300. So why is there that discrepancy? And the answer is kind of again that sometimes there's inconsistency in the way things are accounted for, but the important thing is it in an account that can be identified as either a townhome account or a single family home account or a sort of common shared account, right? And so that's what the important thing is. And so a scan of this information gives us the knowledge that yeah, it's in 5300 and it could be in a different account, but it's appropriate enough in this account in order to make the division. Because if it were in a different account, for example 5300 versus 5100 up here, it would get divided out the same way. So this exercise again kind of takes the longest amount of time because you are investigating these amounts, and there is sometimes a need to go into the invoice level detail, and you have to read the memo descriptions of these and really make sure that it's in the right expense account. And there's a little bit of a threshold of understanding here as well. Like this says townhome payment source lockbox. Okay, so this was a minus $10. This in column W is credit. It's the debit. So a $10 credit to a townhome owner, right? Got coded to admin. So that's not something that is coded directly to townhome on an annual basis. That just gets divided up into 5300 admin. So but it's $10. So kind of who cares? What's the total amount of recurring charges of those that I'm seeing in this? It's like $30 throughout the entire year. So it's not material to really go into the nth level of detail and try to make sure that that gets, coded exclusively to town homeowner, um, reduction of their expenses by $30. Instead, we um, net it out with the entirety of 300. So, okay, yeah, these all relate to AMG, so that's good. Late fees, these all relate to the way we calculate late fees is basically not intuitive, but AMG codes them all to an account, uh, and then pays themselves half of them. So if you look at the dollar amounts here, so it's like we took in 2240 of late fees, and we, half of that is 1120. So it looks like AMG paid themselves 1115, which is, negligible difference of $5 difference. So they put it all to our income, and then they pay themselves half of it. So that's how late fees work. So it's appropriate as far as what I see that, AMG would be a vendor there. Electricity, Duke Energy, nothing of note there. Okay. Value waste services, go to trash removal, Barry's container services, trash removal. So that's all appropriate. Lancaster County Water and Sewers, that's all appropriate. Corporeum, going to Clubhouse Telephone, no problems there. So gate maintenance and repairs, RFP Technologies, that's fine. So getting into general maintenance and townhome maintenance, this is where you have to pay attention, because general maintenance, for example, this item here of townhome retaining wall fence was coded to general maintenance. And so at first I'm thinking this is maybe inappropriately coded. But then going into the invoice level, I have like a view only access to the invoices that we pay to vendors. And so taking a look at the invoice here, it says we need to take down and haul away the old wood fence um, in between a couple of townhomes on Harrisburg Road. And so the total cost of that was $7,300. And then going into Google Maps and seeing, what is that? What does that relate to? That is the wooden fence that runs along the length of the community, and that is a builder installed fence, and so that's a common expense. Here's these wooden fences along Harrisburg Road had to be replaced. Looks like in the early part of 2023, and so because they're the same fence that runs along the length of the community along all of Harrisburg Road. Um, any part of this wood fence along the entire length of the community would have been a common paid expense. And so the coding to general maintenance, therefore, is appropriate. This is also, looks like it was February, March of 2023. So a couple of these were, feel free to pause the video and look at any of these expenses as you'd like to. It's quite interesting. So these are two items that had to be reclassified out of general maintenance into townhome maintenance. And the way we were able to figure that out is the work order numbers 351026 and 351025 relate to two work orders in that's actually in the townhome maintenance already. So it looks like what actually happened is the purchase of something at Lowe's got coded to general maintenance, but then the other part of the work order got coded to townhome maintenance, like a roof leak. So all of that had to go to townhome maintenance, but they accounted for the Lowe's vouchers in the general maintenance section. So little things like that will come up, but that's why we took those two amounts of $72 and made an adjustment there. Okay. GL detail is the next step. We're gonna keep going. US Lawns. So we're taking a look right at the vendor, making sure that the vendor is oh, and I've breezed past the rest of the townhome maintenance. We're getting pretty high up there into the video length, and also I took a scan of this and made sure it looked good, but feel free to pause the video and make a scan yourself and agree with me. And so the next step here is landscaping contract, making sure that the vendors that are coded to the landscaping contract and the amounts are appropriate. So you'll see I've highlighted Yellowstone here because this was a new vendor that we had November of December of last year, and it looks like the entirety of the cost was coded to common landscaping. And so we had to go back to the vendor and find a good split out. Based on the discussions that we had in the August 19th video in order to get this a little tighter. So that was great that we were able to do that. And then looking at the vendor, US Lawns is appropriate to code under common, and the amount as well is 1629. And so taking a look at the addendum to the US Lawns contract, the 1629 goes to common monthly and 2500 goes to townhomes monthly. So that's appropriate as well. So it's just really these landscaping expenses from Yellowstone that we'll continue to scan here and see 2500 getting coded to 6601 landscaping contracts. That's good. We'll take a look at the irrigation repairs. US Lawns did some irrigation work, which is usual, and then Rainmaker, and then we had miscellaneous landscaping cost of 850. So all of these Yellowstone costs needed to be reclassified essentially out of common and then added back into common and townhome separately. And I did that. I'll walk through that, but first let's finish up the GL detail scan. So miscellaneous landscaping here. What happened in miscellaneous landscaping is that essentially this was another item that we had to get to the invoice level. We did some work with AAA Trees back in January of 2023, and looks like all of it was coded to townhome landscaping, but then there was a GL detail, a GL entry correction rather to reduce 4,700 of it that related to the common area. So took a look at that. That looked appropriate. And then just wanted to highlight that the work that we did on the AAA tree removal in November to remove some trees along Caprington was coded entirely to miscellaneous landscape and townhome. So that's appropriate as well. Pool cost here. So I recognize these vendors. These are vendors that are appropriately coded into miscellaneous landscaping townhome. Carolina Pool Management here, and the dollar amounts are aligned with our contract, so that makes sense. Looks like we had a renewal that increased it $50 a month, 600 a year. Pool permits, that's appropriately coded, $175, that makes sense, and pool supplies and all these vendors, that's all good. So that all makes sense to me. And then we'll get to the adjusted total here column. And from here, I will actually make a part 2 video because we are getting up there in the video length, and there are going to be homeowners who have already stopped watching, of course. But basically, the next step of the video is we're going to take this column by column, right? And we want to get to the methodology column, which is the good stuff, where how we divide up the 55,669. So, but first we had to do the other things, and so I'll do a evaluate formula here so you can see what is reduced from common. So we took the two landscaping contract payments of 4616 times 2 plus 850 from the GL detail tab, and we're subtracting that out from common, and we're adding back the amount related to common, and then we are adding back a portion of the one-time mow that was related to common as well, and that gives us minus $6,276 out of common into townhome specifically. But I'll back up a little bit just so we can see this. more clearly. So where did this come from? We just did the evaluate formula. So, the $10,082 related to these three charges. Landscaping, we got the estimate a little tighter. If you watched to hour mark 2 of the August 19th video or so, we did this circle exercise in MS Paint where we encircled the service map. And then what Yellowstone did is they took the service map and clicked around in it and highlighted the areas that are common areas. And so here are the common areas in the community, as agreed upon in the August 19th meeting. And the cost to service those common areas versus the townhome areas, as a matter of our total service cost. Our contract is 55396 with them. So they broke down that 55396 into two different amounts. The common costs are the highlighted costs here, and then the townhome specific costs are also pictured. So this is annually, right? So break it down in monthly, divide by 12, and then multiply it by 2. And so you get the 3485. So we have 3485 related to common specifically. Okay, so that's why in the evaluate formula here, okay, we subtract out all of the Yellowstone costs incurred in 2023, add back specifically what was related to common. Okay, and add back specifically what was related to common as a percentage of total of a one-time mow charge. And so in order to get this, we basically just take the proportion of 2913 divided by the total 55,396, and that's a 0.3775. And so that is how we took the 3 Yellowstone invoices from 2023 and redivided them to be accurate as a matter of the common areas so defined. So from here, so from here we've gotten to column E, and I will go ahead and make a part 2 of the video. Thanks for watching, and we'll see you in just a second.